Okay, well, thanks again, Jeanette, for having me here and Trade Thirsty. So it's great to be here. And let's get rolling. So what we're going to talk about tonight is one of my favorite option strategies, and it's really pretty amazing. So we'll get rolling here. But first off, I'd like to say that for trading now, it's just can be such a great rewarding job because we can do it from any place, and so it's really opened up everything. But one thing I will always strive to or stress to all my members and clients is that you want to be, very focused on your trading risk. And so that's kind of what we're going to be talking about here tonight. So I'm going to share with you this strategy, which is such a great strategy for all different types of market conditions. And it's something I call the kind of the high reward, low stress option trading strategy. So let us get into what the strategy is and all the different ways that you can use it. We're going to talk about the strategy. Then step 2 is the most important option factor. Step 3, how option pricing works, so you understand the difference between what does time decay do to your option price, implied volatility, how that affects it, and then how that helps a butterfly. And then selecting the right butterfly option strategy. And then we're going to look at different trades based on the option butterflies for different market conditions, so you can see all the different examples for the different market conditions and extremes and how they can work, and then how to bring it all together. So the following webinar is purely for educational purposes. Any stocks, options, futures, ETFs mentioned does not constitute advice and should not be construed as a recommendation. One second, I got to get this one thing here done. Okay. All right. I wanted to get the questions out so I can make sure I can answer questions and see what they are. All right, we're good to go. Okay, so just want to go through that disclaimer. Now, a little background on myself. I've been actively trading for over 30 years and was previously executive vice president for one of the largest oil trading companies in the world, Transworld Oil, and ran their international trading desk for over 10 years out of Bermuda. So we were big on the oil side, but we diversified out and got into all the other exchanges, the various derivative markets, all the futures markets, and eventually got pretty big into foreign exchange for all the liquidity that it offered. So, it was a great experience for me getting to trade a lot of different types of markets and seeing all the different market conditions. And we were one of the first groups also to use options. So I started trading options on over-the-counter crude oil back in the mid-'80s and became real passionate about options from that point on. Because just the various reasons that you can use options, there are just so many different functions and different scenarios that you can use them for. Then went on to launch the institutional over-the-counter crude oil options brokerage desk for a company called PVM Oil London, and they're the largest privately owned oil brokerage company in the world. So really another great learning experience for me doing that with PVM, just learning all the other option structures. And actually the first time I really got into the butterfly type spread was brokering these types of strategies for some of the big hedge funds. I remember there was a big hedge fund that put on like 25,000 contracts of a oil butterfly, and it was just for a certain market condition that they saw, and it was a good way for them to structure a low risk, high reward type of turnout trade. Now, step 1 is this high reward, low risk option strategy, and it can really help you to reduce your market stress. So when you're getting tired of market uncertainty, where the market's up one day, down the next, that kind of, up and down volatility and periods of high volatility, that can really start to weigh you down. So there's one really great strategy that can give you a trading advantage in any type of market environment, and I kind of call it that low stress option butterfly spread. So option trading in general has so many more advantages than trading stocks, but as you probably know, it's a bit more complicated as well. And for the individual trader, options can also be a little intimidating. But the option butterfly is one strategy that is really a must for your trading toolbox, and you'll see why tonight. Now, unlike other strategies such as iron condors, credit spreads, or debit spreads, the butterflies are very dynamic and can be traded in a variety of different for different reasons and different trading goals in mind. So they can be used for income. It's a great way to generate income from stocks you think are going nowhere in a short period of time. So this can contribute to your overall portfolio returns in a flat market. It's also non-directional. You can use it for non-directional type of scenarios. So in their simplest form, butterflies are a delta neutral or non-directional trade. And sometimes, trying to pick direction of stocks or the overall market in general can be pretty confusing, stressful, and expensive if you keep buying and getting it wrong. So the delta neutral butterfly strategy can be set up to take advantage of taking that guesswork out of your trading. And it's a really high reward, low risk strategy that can be constructed at a very low cost, giving you really big returns. So you can get 10 to 1 or sometimes greater returns. Reward to risk is pretty common. And then the other way, my favorite way to use it, I'm a directional trader, so I love to use these things for directional trade setups. And the directional butterfly spread, it offers you a really great bullish or bearish exposure to the market while managing your risk and retaining large potential returns. So you can keep your capital costs really low with these types of strategies. Now, even though the butterfly spread cannot offer unlimited profit potential, either upside or downside, they're going to usually cost you a lot less than if you're just buying outright options, outright calls or puts, and offer you kind of an amazing, really positive risk-reward kind of trade setup. They're also the best thing that I've found for hedging. So the directional butterfly can be used as a fast-to-execute hedge on positions that are moving fast or against you quickly. So you can set these up as a hedge really quick if you know how to construct it. So constructing a butterfly, say, around a strike that's under pressure from another core trade that you put on, such as you might have a credit spread, short credit spread set up, or a debit spread that's being threatened as far as the strike prices and everything. It becomes a great way to control the risk around that core position, and this is going to also then lower your trading stress. So this allows you, when you do around a core position quickly using the butterfly, what it does is it allows you to keep your original position open, and many times that's all you need, for that trade to move back in your favor. And then at that point, you can then just remove the butterfly hedge and stick to your original trade. Also, long-term out-of-the-money put butterflies can also be a much cheaper method of portfolio protection than pure long puts. So if you're trying to protect, the downside of a particular market potential correction to the downside, you can use these as a cheap way to buy insurance. They're also known as kind of low maintenance. The butterflies are sometimes, you'll even hear them called the vacation trade, due to their low risk and need for only very infrequent monitoring. So the butterfly trades, they start out really slow moving early on in the trade, but as you get closer to expiration, that's when the excitement can pick up, and that's where you big profits. And what you want to take advantage of, this is what we call the profit tent or profit zone. It looks like a tent, and so when you get up into that top apex of it, that's your max profit potential. So once you get inside that tent, you start making money, and the more closer into expiration, the more money you can start making. So step 2 then is the most important option factor for profit generation using the butterfly strategy, and it comes down to really understanding the concept of time and its effect on the price of your option. So that's the big thing, is time value, and it's used for trading strategies that take advantage of the accelerated time decay of an option into its expiration. And the butterfly strategy, they're very tied to the time value and the theta decay, and we can measure. That's the really cool thing about options. We've got these option Greeks that we can measure certain components or parts of an option trade, and theta is the one that we can measure time decay and its impact then on the price of your option. So with options, the time value is also referred to as the extrinsic value of the option. It's the premium that a rational investor would pay over its current exercise value, which is the intrinsic value, and based on its potential to increase in value before expiring. So it's this probability, it's always going to be greater than 0 Thus, an option always going to be worth more than its current exercise value. So the change in the value of the option, again, is what we can call the time decay, and we can measure that using that Greek called the theta. And here's how the theta works. So theta tells you how much an option price will diminish over time, and that's the rate of time decay of that stock option. And time decay occurs because that extrinsic value or the time value of the option is going to diminish, and it goes to zero at expiration, so it's a decaying asset. So by expiration, options are going to have no extrinsic value left, and all out-of-the-money options will expire worthless. And the rate of this daily decay all the way up to its expiration date is estimated by the option theta value. So by understanding this option theta, it's extremely important for the application of option strategies that seek to profit from time decay. And basically every option strategy that you do is going to be affected by time decay, so you might as well understand how to use this theta right away. So option theta is going to be, you're going to have values that are either positive or negative. So all long stock options, so if you're long a call or long a put, that's going to have a negative theta value. And that indicates that they're going to lose value as expiration draws near. Now all stock option positions that have a positive theta value, those are ones that are short stocks, like short calls, short puts. And those have a positive theta value, which indicates that the position is going to gain in value as expiration draws nearer. So by knowing the two different effects, you can structure your trades based on those dynamics. Now theta value is also going to be highest always at the money, and it gets progressively lower for the in-the-money options or when you go out of the money. So the in-the-money and out-of-money options are going to have a much lower extrinsic value, giving little time left for that decay. So here's an example. So say you have an option contract with the theta value of minus 0.10. So this is telling you that you'll lose $10 per contract every day, even on weekends and market holidays. So remember, one option is equivalent to 100 shares, so it's $10 per contract in this example. So if you're a buyer or a holder of an option contract over a 3-day-long weekend, and that price that you paid originally was $1.40 or $140 per option contract, and it has this option theta of minus 0.10, you're going to find that the price of that option is going to be at $110 instead of $140 after a 3-day weekend, and that's your theta decay. And it strikes again, theta decay starts hitting you, and you're not even aware of it, but it's there. Okay, so I'm just checking questions here. So also the option theta is not going to remain stagnant. So it's going to increase as expiration draws near, and it's going to decrease as options go more in and more out of the money. So in fact, the effects of option theta, it really gets rolling during the last 30 days of expiration, and then it really soars. So here's a time value kind of chart of the, what it looks like here if you go out in time. So if we look at, let me get a pen here. So when you start out, 120 days out, the time decay or theta is very, very slow, very gradual. You can already even see it. Sometimes you won't even see it listed on your option chain. But as you get 30 days out, and then as you get into those weekly options, it really starts to, decay rapidly, and I call it turbo time decay. So it's kind of like, big major swift current going out, and you're trying to swim against it, you're going no place. So if you're constantly trying to buy options as, you're going toward closer to expiration, the theta decay is really going to, upset your pricing unless you get a really good push upside momentum on, the options that you're buying. So it's very important to understand this concept and how it affects you from a distance or as you get closer in. Now here's an example of theta values. So this is Amazon 7 days from expiration, and you'll see the difference in how much greater the theta or time decay is as you get closer to expiration. So on this option chain, here, this is Think or Swim. Here are the strike prices. So here are the calls, and here's the theta value here. Here are the puts, and here's the theta value there. So in this example, Amazon's trading at 765. So you come down here at the money 765. You come over to the calls, and you see it's 39-cent theta decay. So that's $39 a day. So if you were to buy this, 765 call, and let's say you paid $680 for it, basically the next day, if it's gone no place, it's going to be down in value by roughly 40 cents. So it's going to be 640. So that's the theta decay. So at the money, it's the greatest, and here's the theta decay for the put side. Now, as you go deeper in the money, say the 750 here, you can see that that theta value is less, so less time decay, and the put side less. Now, as you go out of the money, 785, you can see the theta value is less, and on the put side, it's less. So the biggest impact is right there at the money, and it's greater the closer you get to expiration. So the next slide I'll show you when you're further out. In this slide, you can see it's 42 days from expiration, and if you look at the money strike here, 765, you can see that the theta value here is only 22 cents. So it's almost half of what it was when you're 7 days out, and the put side is 21. Now, as you go in the money, it's less, not as great, but it is less. And as you go out, it's less. But the big thing here is, when you're 42 days out, or the further out you are from expiration, the smaller that theta or time decay will be. So, if you're a buyer of options, it's always time is kind of your bonus there. So if you're buying options, you want that gift of time so you don't have as much theta decay. Now, then the next thing is then how does the option pricing affect, how's it affected by these different components? So the major components for the value of an option will be time value times the implied volatility times the intrinsic extrinsic value, or the underlying value. And once you know these variables, then you're going to be ready to price your option that you're looking at and know what its option premium should be. So there are the other Greeks that go into this, but these are the main components for the price. So here's an example of how this flows through. So this is a weekly option chain. So most of the options now are most of the underlines, most of them are having weekly options. So in this situation on Thursday, you're going to have 100% time on that option that first day. And then here's your implied volatility. So time value times the implied volatility times the underlying value, that equals your option price, or your premium. So you start out here the first day, that premium's going to have 100% time in that value times the implied volatility. We'll keep this constant so you can see how the price flows through. So that gives you a value of $300. Now, when you come in Monday, you can see that the time value of that option now has been cut in half. And so even if you increase the implied volatility, in this example, to 800, this is staying constant. You can see that your premium, your price of the option, just barely went up to 400. And if you say you had an implied volatility here of, say, just 300, then you're actually losing money. So, 0.5 times 300, this value would be 150. So you can see the importance of that impact that the theta decay has on the price of the option, and then also the difference in implied volatility when it goes up or down, the impact it has. And they're both going to go to zero at expiration. So by understanding that, you can build structured trades around the benefits of either time decay or implied volatility crush, etc. So step 4 then is selecting the right butterfly option strategy. And one major goal of every trader, in my opinion, should be to select those trades based on what's going to provide you the most consistent positive return with very low defined risk, and not always that greatest return, not always that big home run. And one of the best ways I've found to achieve this is by knowing the various option strategies out there. And in this particular situation, we're talking the option butterfly strategies, and knowing the ones that are available and then how they work, and then selecting the one that's going to be best suited for the market environment you're trading in. So the various butterfly strategies are following. You've got the long call or put butterfly. You've got a short call or put butterfly. You've got what we call the broken wing butterfly, which could be calls or puts. And then you've got what we call the unbalanced or ratio butterfly, directional butterflies, and then hedging using the butterfly defense, which we'll go through, and then you've got the iron butterfly. So there's a lot of different variations of this one strategy, the butterfly strategy. So that's what really makes it pretty amazing, because you can do a lot of different things with it. So let's go through some different trade examples so you can see the benefits and how, these things can really be advantageous to certain market conditions. So here is the directional option butterfly, just what we call the balanced butterfly, and this is on the ETF SPY. So these are great for, ETFs, the SPY, QQQ, IWM, because they've got really good liquidity, really tight spreads, and lots of trade. So they're great for the ETFs and great for various stocks as well. So in this particular example, this is a SPY long put butterfly, and this trade was set up on the 15th. The market was trading at $202, and this is what I call a target. These are all basically what I call target trades, because you have to have a target, in order to establish your butterfly at that specific target. So I like to use them directionally, and what I like to do is use momentum. So for a directional trade, I want to see, is the momentum up? So would this price go up or would it go down? And then I want to look at Fibonacci levels for various targets, and then I want to look at open interest to see if it tells me anything about a certain target. So kind of three factors I put into the kind of formula there. So the target on this particular trade setup was $205, and that was based on high open interest at that particular strike. So these are very short-term trades, which are perfect for swing trades, short duration, so you don't have a lot of overnight exposure. And so this was put on the 15th, taken off on the 18th. So the momentum was up. The Fibonacci levels were put in. I always look at my fib levels. And here was the fib level here. We were looking at a 1618, which came in right at 204.50, basically right here. And there was good open interest there. So it was a perfect setup for a butterfly. So here was the spread. It's a dollar-wide trade. So this was going long the 206 put, short a 205 put, and then short a 205 put, long a 204 put. So it's basically two vertical spreads together sharing the same body, that 205. Now the beauty of this trade is, you can see here that this trade was a dollar-wide spread, and it only cost $14 per option contract to put this trade on. So when you do the math on that, you can see it's a dollar-wide spread. So 100 minus 14, you've got a potential theoretical profit of $86 per contract, option contract, on a risk of just 14, and that's a 6-to-1 risk reward to risk, however you want to look at it, 614% theoretically. Now, you'll never usually ever make that full theoretical profit, but think about it. If you can make 20% of that, 30%, 40% of that, these are great payoffs. Now, this was a 3-day duration, and this trade ended up making $37 per option contract on a risk of 14. So that's a 265% return. So over 2-to-1 risk reward. And this was just a 3-day trade. So it's a fantastic leverage on very low risk. So you can see the debit here. It's a debit paid, so that's the max you can risk. Dollar-wide spread. So you can do these with puts or calls, but and that's how you do your directional skew. So here's what it looked like, the payout. So put on the 15th, off the 13th, off the 18th, and you do $14 at risk. You do 5 contracts, 10 contracts, whatever. You can see on a $37 profit, these can add up to quite a nice return to your portfolio. So here's that profit 10 I talked about, and you can see here that purple line, you can probably see it, is right almost identical to the actual teal colored line, which is your underline. So when you get it up there at expiration, right towards the end of the day on that expiration, you're getting any time value that's left in it's being stripped out, all the implied volatility stripped out. So you're getting that benefit, and just really accelerates your profit right into expiration. Yeah, you'll get out. You always close them out. I'll always close it out at expiration unless it's out of the money. Now, this is my personal favorite, and this is what we call the unbalanced butterfly, or a ratio butterfly. So you can do this with puts or calls, and then structure it to either an upside move or downside move by using either puts or calls. So this is a setup to show you how it was used on Facebook. So it's what I call, this one was done for a directional volatility breakout. So it was, again, a directional trade using the ratio butterfly. So think about this trade. I mean, so this is my trading model. We're in what we call a volatility squeeze by these dots. It sets it up to potential big break up or down. And my momentum, these indicators below, you can see a lot of green here. So that's signaling really strong upward price momentum. So I want to go in the direction of the momentum. I go with the trend line break. So a lot of different trades you could have done here. You could have just bought the stock. You could have bought calls, etc. But the other thing that I noticed here was that the $130 strike was also a fib level. So that was my target. So the target was $130. And so the trade was set up on the 2nd. It was trading around 126.50, and the exit was on the 7th, so a very short duration trade. And this was set up for a target of 130 or greater. So it's looking for at least a minimum of 130 or greater. Here are the Fibonacci levels. I always do the fib work, so from swing high to low here. I had a nice target here, the 1272 extension at 130. So that was my initial target. And then if it went above that, the way I had this trade structure, I'd still benefit, even though it was a butterfly. It was what we call a ratio butterfly. So here's what the setup looks like. So in this type of setup, you're going to receive a credit. Okay, so this was a put ratio butterfly structure for an upside move, and it was structured where the credit received was $75. It was a dollar-wide spread, so your risk is the difference. Only $25 at risk per contract. Very, very low risk. So this puts a maximum potential theoretical profit reward of $175, which would be 700% return. So here's the option table here. You can see the setup down here. So 131, 130 put spread, and then you're selling 2 of the 130, 129. So bull put credit spread, 2 of those, so 2-to-1 ratio. And you can see here, if it was to pin at expiration at your 130 strike, you'd get a maximum profit theoretically of 175. The maximum you can lose on this trade is 25, and you got a 75 credit. So if it keeps blowing to the upside greater than 131, you keep your $75 credit. So this trade actually ended up at $55 profit, because it hit the target, took it off. That's a 220% return, 5 days. Now, this is the great thing about it, too, is that you're risking $25, very low cost, right? Very low capital cost. Your profit on this example, you can see, was 220% based on that risk. But if you look at the return on equity, if you'd just done this trade and you'd bought Facebook and then sold it at that same level, your return on equity was 3.9%. versus doing it with this structure, 220%, and you only had a risk of $25 versus a much greater risk here if you bought the shares. So that's the thing that I love about it, it's that risk reward. And here's what it looked like. This is what it looks like. It's different looking, the profit tint. You can see the structure here. And so what it says here is if it goes above that 131, you're keeping the credit of $75. And here's your best profit area inside that profit tent. So this was taken off at like 131 right here. And so that was like a $55 profit on a risk of 25, 220% return. So yeah, so your stop, you can use stops, but what the best thing to do is if your risk is 25, you use that as your stop, right? So just leave it alone. $25, that's what you're going to risk. So if you're comfortable losing $25 on 1 contract, 5 contracts, 10 contracts, that's how you adjust your risk based on that capital at risk cost. Now, when they get a little bit more, greater, you can cut it. What I usually like to do is cut it 50% of that or 60%. So, but that's the beauty of these things. Sometimes you can structure for very low capital costs. And here's another one that we set up last week. This was an amazing one. This was on NVIDIA. So it, again, was a directional trade set up to the upside using a ratio put butterfly. So the same structure. I look for momentum direction off momentum. I look for Fibonacci levels, and on this one, it was just basically another what we call volatility breakout trade out of a volatility squeeze here. So this was on NVIDIA. It looked good to the upside. So it was not looking for a big move, just up to $65. So this is the really great thing. You can play these on very small moves. So it was trading on the 21st at 64. The target for this trade, all we wanted to do was go up $1 to 65. And I'll show you what happened. So we got out a part of it on the 22nd the next day, the balance on the 23rd, which was Friday, at 65. So it popped to the upside, stalled right at 65, pulls back, and actually went out on Friday, expired almost exactly at 65. So it was about as good as you could get on this trade. This is about as perfect as you get. So you know how, in trading or anything in life, you don't get too many things that are perfect, but this one was almost perfect. So just the way it turned out, but it was structured basically so you would profit at $65 or higher. Okay, that's the beauty of the structure. And this so happens it just went out when it got here on the 22nd. That was Wednesday. It went straight. Look at Wednesday. It didn't go up much. I mean, it didn't have to go much up. 65 took off a big chunk of that position, left part of it to see what would happen the next day. And the next day, you can see it just sat there. So here's what the outcome looked like. So here's the trade setup on the 21st. So credit received on this one, it's a dollar wide spread, $29 credit. So the difference is you're at risk of 71. But this was so close to that 65 strike, good momentum. It looked great to the upside. So that would put your potential max profit at 129. If it was to pin right there at $65 at expiration on the 23rd, that's the maximum theoretical profit. Okay. Now this trade, that would be 181% return on your capital at risk of 71. So on the 22nd, it popped up to 65, went ahead and took off a big part of it, made $44 per contract. So 44, your capital at risk 71, that's a 62% return in one day. If you just done a stock trade, your return on your equity was 1.5%. So that's what it looked like. So $29 credit, dollar wide spread, ratio butterfly, potential profit of 129. So you've got a lot of different profit potentials on this trade. It's not just one dimensional. Now here's the really, here's what it looked like on taking it off on the 22nd. So you can see that profit tent, and here's where it went out. It was at 65.02 right there, one day before expiration. So exited out a part of it for $44 profit. That's a 62% return. I'll take that all day long, and that was a one-day trade. So, it adds up when you do 4, 5, 10 contracts. It's over $240 on that chunk. Now, the next day, kept some on, and this was just amazing. Kept watching it, and it kept watching it, and it just kept sitting here at right around $65 all day. So as it sits there, the closer it gets to expiration, see that purple line? That's the actual option, what it's doing. So all the time value is being stripped out. All the implied volatility is being stripped out. Everything goes to zero. So at the end of the day, when it expired, this sucker had $119 profit. So the day before it had 44, still at 65. This day at 65, it had 119. So see the difference? It's huge. So that's the fun of it. So that was 167% return at the same strike price, 65, as it was the day before. So that's what it looked like. It went from a 29 credit to $90 debit. So that's a really neat strategy. Now here's just to show you an example. This is the iron butterfly option spread. So yeah, looking at some questions. I'll get into the questions here in a few minutes. Okay, so here's the iron butterfly spread. So this is on JP Morgan on the 16th, and it was trading at 60.90. This was a one-day trade. The target was to 62.50. This was based on a high open interest analysis. That's a big part of some of these butterfly type trade setups. So good open interest at the 62.50. So this was a really low risk trade to set up to see if we could get to 62.50 just one day later. So it was trading at 60.90, went out the next day at 62.28, very close to that 60.50. So one-day trade. So here's what it looked like. So this is basically, if you look at an iron butterfly, you can look at it two different ways. You can either call it a short straddle, because you're short a call, short a put, and then you're long a strangle around it. Or the better way really to look at it, so you know that these are two vertical spreads, is you look at this as a bear call credit spread at the money 62.50, and then a bull put credit spread at the money 62.50. So they share the same body strike, the short strike. So by doing this, you're collecting a good credit, and you're wanting this to be implied volatility crush. You're wanting volatility to go to zero, and you're wanting time value to go to zero. So this takes advantage of both, which is perfect for that kind of butterfly. So this one was set up collecting $65 credit off of selling this structure. The difference is you're at risk of 35. So, you're not going to make that full 65, but if you can make 20%, 30%, 40% of it, 50%, 60, it's a great trade. So this made over 50% of that. So it made $42 per option contract. That's 120% return on your capital at risk. So this is that structure. You can see how that purple almost was in there, almost pretty close to that 62.5 strike. So it went out at 62.28, very, very close. It went out right here, not quite there, but that was good enough for $42 on a $35 risk. So nice trade set up for, 5 contracts over $200 there. So that's the iron butterfly. So that's the other one. Now, the last one, no, this is a broken wing. So this is also called a skip strike butterfly, and this is an example to show you on Apple. So this was an Apple directional broken wing put butterfly setup, and this was set up, Apple was trading at $112. Now in this setup, again, momentum was to the upside, so I was looking for a trade setup for an upside move, but also a huge amount of open interest at the 110 strike. So there's a good chance with Apple coming back to that big open interest if it rolled over and failed. So the setup was on the 13th, and it was out the 15th, and it went out at 109.97. So here are the fib levels, high to low. It gave you a upside target right up here at 112, and then it gave you the 50% retracement right here at 110. So 50% retracement, a lot of open interest there at 110, great setup for a broken wing butterfly in case it was going straight up. By doing it as a skip strike broken wing, you can make it a lot cheaper on your cost. So this is what that setup looks like, and this was using puts to make it an upside move bias. So bought the 111 put, sold the 110 put, so here's your vertical put debit spread, and then sold a 110 instead of doing a $1 strike, skipped a strike, so skipped the 109 and did it 108. By skipping a strike, it reduces your cost. So the cost on this trade was only $10. So potentially, if this thing kept going up, your cost was only 10, and whatever you made, was a great return on that low cost. So here is the risk on this was 110. Now, this particular trade, it went up, and then it came right back down to that 110 strike. So it actually did settle almost at 110. So it went out almost exactly to the penny at 110. And this realized profit on that was $70 per option contract. The cost was 10. The risk, though, was 110. So this made a 64% return in 3 days. You can see that profit tent there. So if it kept going up, your cost was only $10. So this is what we call the skip strike butterfly. So it's another variation of a butterfly. And then the last thing I want to show you here is the butterfly hedge, defense. I talked about earlier that this is what I found to be the best type strategy for defending any type of vertical option trade. So in this example, you're going to see the original position was a short bear call credit spread. And then the spread started going against, the market started going against the spread setup, so defended it by converting it to a butterfly. So the trade setup this is what I call a kind of a directional price divergence type trade setup. So I love to do these on the SPX or the index options. So when you get a market that's going just up and then all of a sudden it goes sideways, it's a perfect condition to sell out of the money bear call credit spreads. You can see momentum was going down, so divergence in momentum. So set up a bear call credit spread out of the money. But every time you do a trade, you better have a defense what you're going to do to it if the trade goes against you. So in this particular trade, I had a defensive hedge strategy that I wanted to do if it was going to go through 2070. So it was trading at 2055. My post line in the sand after that trade was put on was 2070. So always have that set up. Now, so the short trade was on the 5th, and you can see up here was out of the money 2055 was trading. So set up a bear call credit spread right up here. So set up the 2085 short long the 2090. So $5 wide spread out of the money. So when you're doing out of the money credit spreads, if you go close to 1 standard deviation, that gives you statistically, as soon as you enter that trade, about a 68% probability of a winning trade. So they're a great strategy, especially if you've got a market that may move sideways and momentum's going down, which was the case. But if the market breaks up, you've got to defend it because you've got a lot of potential at risk from that credit spread. So here's what it looks like. Trade 1 was short the bear call credit spread. So it was shorting the 2085, buying the 2090 bear call credit spread. It was done approximately 1 standard deviation, so that's 68.2% winning probability when the trade was put on. And that's the basic, when you do credit spreads, that's what you're looking for. So it made $105 credit. Potential at risk, though, is $395, so it's a negative risk reward. But these are set up for that because you've got a 68% probability going in. So it would be a 26% return if it closed, out of the money. So it's a great strategy for income. So there's what it looked like going in. Now, my line in the sand, remember I said 2070, if that got threatened, which it did, I don't think twice, I automatically then went to my defense, and that was setting up a butterfly. So by doing that, I'll show you how that was done. So trade 2 was buying a long call debit spread, and it was trade, the market was at 2070, 71. So bought the 2080 call, sold the 2085. So that's your debit spread, cost $230. So here's your debit spread side of it. So vertical debit spread. So when you put the 2 trades together, what do you get? So the first trade, you can see trade 1 was the bear call credit spread, received $100, $105 credit. The second trade was a long call debit spread, 2080, 85. What do you notice here? So the short position, 2085 of the bear call credit spread is short at 2085. The short portion of the debit spread is 2085, so it shares the same body, the short. That creates your butterfly. That costs $230. So the difference, this whole trade then was reduced to an exposure of $125. So from original exposure of $395, the difference between the 105 less the width of the spread, reduced this trade down to a maximum you could lose would be $125 if it went straight down or straight up. And this is what really helps to reduce your stress, because if you've got a trade that's going against you in this situation, the credit spread and the market's going up, and you've got a potential that you could lose $395, and if you do nothing and you do lose $395, you're stressed out. So if you convert it quickly before it gets to your short strike to the butterfly, then you have time. You bought yourself time to think, well, what do I want to do next? And if you do nothing, instead of losing $395, you only lose $125. So that's the way you have to do your trades. So the line in the sand was here, so set up the butterfly 280, 285 debit spread, 2085, 2090 credit spread together as your butterfly. Now this went screaming to the upside, so I was like, wow, I'm glad I did the butterfly. And it went up to 2097. So here's the outcome. So closed the trade out on the 20th and just legged out. And so, or you could do nothing and just lose 125, but went ahead and legged out. So it was trading at 2097. So closed out the long call debit spread, which was almost, max profit basically. It was max profit at 500. So that made $270. Then the market pulled back just a little bit during the day. I use a 5-minute time frame. Pulls back. When it came back a little bit, covered the short bear call credit spread that I had shorted at 105, closed that at 350, so lost $245 there. But made 270 there, lost 245 there, so all in all, made $25 versus losing $395 if nothing had been done. So if you're trading, you never want to take a max loss on any kind of credit spread or any of your spreads. So this is the best way to defend any kind of vertical spread. So I wanted to share all this with you tonight because it's just a really awesome, fun way to trade. And I've gotten, I look at these ratio butterflies before almost I do anything else. So again, it's a great strategy. Once you get it down, you're going to want to do it all the time. Yeah, these trades were all before commission. But remember the SPX. So I want to now go a little bit further and tell you how you can bring all this together to learn more about the strategy. I can't teach you all the things you know in just 1 hour, but I've got a fantastic course that I did. This was a live course I did about a month, 2 months ago. I can't remember exactly, but it was a 4-hour course, live course that I did on the butterfly, amazing butterflies. So all the different structures I showed you tonight, this is a 4-hour course going into all the detail of how to do those trades. Now this is all recorded and broken down in 30-minute modules of the live course, plus you get the 230-page PowerPoint training manual. So my courses, if you've ever taken one of my courses, they're very, very detailed. And so here's the link, I've got 30 spots because I want to keep it small enough. I've got a bonus where we'll do a live follow-up Q&A. So once you've gone through the course, and you can come in and then ask questions, and we can go through trade examples and questions, etc. So with this package, you're going to get the 4-hour, I think it's 4.5 hours of just everything 100% butterfly, from all the different ones I showed you. Then we'll do probably 2 weeks, we're going to do a live Q&A follow-up, so you can come in and ask whatever questions. If you can't make the Q&A follow-up, it'll be recorded, so you can just email your questions into me, and I'll answer those first so you can see them. And then you're going to get 2 other bonuses. You're going to get my option strategy manifesto. It's 15 option strategies that I like. It's a printout you can put on your desk with the diagram of the strategies and explanation what they are, how they work. And then bonus 3, a Greek power tool guide, which you can print out, put on your desk. It's all the Greeks. So it's, delta, theta, gamma. It's a quick reference guide that you can use on your desk if you're thinking, oh, I forgot, what does gamma do? It'll tell you. So all this tonight for $97, and you'll get the on-demand course, 213-page training manual, satisfaction guaranteed, 0 risk. So it's a win-win for you. If you don't like it, send us an email and we'll send back your $97. So again, if you're interested in this, put in that powercycleTrading.com/win, W-I-N all together, or just copy and paste that link, or I think you can just even click on it. Now, the other thing you're going to get if you've never been a member of my trading club, I'm also going to give you 1 free month to my trading club, and I'll go through what you'll get out of that in just a minute. So again, this is a step-by-step blueprint course on trading the option butterfly spread. So you're going to learn all those different strategies, structures that I just showed you, but in more course. So it's a 4+ hour recorded course, 30-minute modules, the 230-page training manual. These are all with a lot of good trading examples you can go through and look at to see how they work, how the structures are. Well, if it moves lower, there are a couple different things you can do, and it's all taught in the course. But the big thing about these strategies is that I think I mentioned earlier that the cost of these trades are so low that a lot of times you can just use the cost of the entry into the trade as your risk. So that's one thing you can do. But it's all laid out for you in the course. Then a big part of the course we'll go through what's in it is also the defensive strategy, how to defend trades, and then we'll do the live Q&A. 1 month free trial to my trading club. The bonus 2 is the 15 option strategy guide. So this will be a printout. You can put the different option diagrams and then describes what those are: covered calls, back ratio, spreads, etc. So it's a nice printout for your desktop. And here's the link again. It's powercycletrading.com/the word WIN. So put that in, and it'll pull up a payment link, which you'll just see the option butterfly course. So you're not going to see the bonuses attached, and you'll get those bonuses if you are the first 20 here tonight to sign up. And then the bonus 3 is the Greek Power Tool Guide. So this will give you, just for your printout on your desk too, to tell you what theta, gamma, delta, so you have a quick reference if you're scratching your head, oh, I forgot exactly what is gamma now, what is vega. So that's a free package too. Now in the course, this is what's covered in the course. So first off, the core basics that many traders really don't even get as far as butterflies. So butterflies are kind of a mystery to a lot of traders, but they really shouldn't be. They're amazing, and they're pretty simplistic once you get into them. And then what option Greeks do you need to really know? So I'll just teach you which the vital Greeks are. I mean, it's not going to go in depth to the math of all that stuff. It's just what they do to the spread, how they affect it. And then how, why, and when do you use the butterfly? And do you use the long call or put butterfly? Would you use a broken wing butterfly, a ratio butterfly, directional butterfly, iron butterfly, vacation butterfly? Any trading platform allows you to trade the butterfly. If you've got TradeStation, Thinkorswim, any of them. But also in the course, you'll learn that the butterfly is basically just a combination of 2 vertical spreads. Once you get that concept down, it makes it a lot easier. You can leg into them as well. So then you'll also learn the optimal times to capitalize on the different butterfly strategies, how to structure the setups so you can get these really high returns, 10 to 1, and sometimes you might even see as little capital as $10. On some of the ETFs, you can literally do it for as little as $10 on some of these balanced butterflies. So how do you profit then from the option volatility collapse and theta decay? So this is the big part of the butterfly strategy, is that volatility collapse and the theta decay. So how does that work? How do you profit from that? And a big part of these things, is a great part of it, is to understand the pinning aspects of a butterfly, how to use open interest and use that to trade the butterfly. So how to target that maximum optimum option expiration pinning strike and profit using a butterfly. These are fantastic trades, really high return on risk. And then price target analysis. How do you target your setups? Like I said earlier, these are all target-based trades. So for my targets, I use Fibonacci and that open interest mostly. And then a step-by-step checklist, how to put that butterfly on, take it off, execution of the butterfly. And if you don't want anything else, nothing else out of this course, this is worth this course times 10. How to use this butterfly spread to defend a vertical debit or credit spread, how to use the butterfly to hedge a core position. If you don't get anything out of it, this is worth so much money to you right here, just to learn how to defend a trade using this strategy. So, and it's got a lot more. Now, you'll also, like I said, get 1 free month to my trading club if you've never been a member. And we have a virtual trading room open each and every day at 9 a.m. Eastern. I'll get in about 9:20, 9:25, stay in there first hour and a half, and for the last hour we look at all types of trades, futures, day trades, seasonal trades, oil trades, butterfly, whatever, and then I do a nightly video update every night with what's going on with the markets, where they're headed, the basic trade setups that we're looking at that day or put on, set up that day. Every week we do a live Q&A, did one today, it's hour and a half every week. Traders Educational Vault, and then for every month you're a paying member, 97, you get a $20 credit that you can use against any course at a discount of 40-50% off everything I have and all my indicators. So a lot of good stuff there for you, and here's the link again for anybody that's interested. And again, it's a money-back guarantee. So knock on wood, I've not had anybody ever ask for a refund on this course, so that says a lot. And here's just, 10. He said, thanks, Larry. This was one of the best 4-hour presentations I've listened to this year. I'm also left with imagining the opportunities available for having fun and making dollars at the same time with this knowledge you imparted on us. So just a lot of good input from, past clients and stuff. So if you're interested, I hope you'll sign up and follow me from now on out, because I do, you know, 1 or 2 different courses every month, teach a lot of different option courses, and also teach a lot of different directional trading. All my trading really comes down to directional trading, and I use my indicators for that, which will then also be available to you as a member, so you'll get a discount on all that good stuff. And again, no risk, so it's a great win-win situation. So powercycletrading.com/WIN, and it'll be all good for you. And I look forward to working with everybody here in the future. Thanks, Kelly. Appreciate that. Wow, I got to put that comment in. That makes me feel good. Go out on a feel. This is going to put me going out on a feel-good note from Kelly. If I can put that in, I appreciate it. Oh, didn't get it. Hold on. Let me see if I can copy and paste this. Okay. Any specific questions here before my time is up? I think I'm almost up, but well. Oh, hold on. Darn it. Here's the link. Did y'all get that? powercycletrading.com/win. Hey, Carlos. Does everybody see that link? I was sending that link just to ourselves. So here's the link again. Now I'm over 20, but the link was already put in there, I guess. But it was going just to myself. So you should be seeing that link now. See it, powercycletrading.com/win. Okay. So use that link there. And I'll just hang around a little bit longer because I thought that link was going out, but it wasn't. So my apologies. I guess it somehow did go out because it got a lot of signups already. Yeah, I guess maybe maybe Jeanette got it in there. So use that link there. powercycletrading.com/win. Yeah, sure, Rick, you can. You know, if you sign up for the course here tonight, definitely just, you know, send me an email send me an email saying that I said that you could, if my assistants see that you were at some time a member.
All right, Larry, I did post it for you. I posted
Okay, thanks.
So I hope it went out.
Well, thank you, Jeanette.
Sure, no problem.
One sec, sorry. Thank you very much for having me here.
Yeah, man, you know you're always welcome here. It's like home, huh?
Yeah, exactly. These are good friends, Hubert and Jeanette, and so it's great always to work with them. So thank you very much.
Yeah, it looks like a lot of people have already bought it, and they're thanking you already. So that's good.
Appreciate
Good for you, Larry, and you guys that are joining Larry. You know, you've got a
Yeah, Jeff, it might be if you've taken my butterfly course in the last month, then this would be the same one because this is on demand. Here's one. Saul just took the course, and here's his comment. I mean, it really is a great course, but you know, I think all my courses are great, but I love this course because I love this strategy so much, and so you know, it's great price point as well for $97. I don't see how you can go wrong. You're going to learn so much in this course just in general. Okay, well, thank you so much, everybody, and have a great rest of your evening. And should I stop this recording, Jeanette? Because I've got it. I see a red going on here because I'm going to be leaving.
yeah, man. Go ahead and stop it.
Okay. Okay,
And, okay,
great.
good. Okay, perfect.
Thanks, bye.
All right, sure. And John just posted I took the prior butterfly course. It saved me a ton. And look, sometimes these things are not about helping you figure out how to make money. They're figuring out how to help you save money, and that all works
Exactly
together.
what I mentioned earlier. Really, trading is about managing your risks. So, don't always be looking for the home run. Just take singles, and you'll stay in the game and be successful and be happy. Okay.
All right, Larry. Well, you have a great night and have a good football weekend. I'll be thinking about you and your team. Y'all on a bye week this week? You got a real game?